So, hi all, this is Akshara Menon from Famous Bazaar. Welcoming you to this webinar on the topic spotting the opportunities in the current market. We have an expert to talk on this today, Mr. Trilok Agarwal. He's the fund manager of Ambit Good and Clean Mid Cap Portfolio and Ambit Emerging Jane Small Cap Portfolio at Ambit Asset Management. He has over 17 years of experience in investment and equity research. Before joining Ambit, he worked with Diamond Asia Capital and Aditya Birla Sun Life Limited. He was the core member of the investment team that oversaw equities over $2 billion. In the initial phase of his career, he tracked research across various sectors, including auto, telecom, consumer, discretionary, chemicals, and cements. His cross-sector exposure and eye for detailing ensure the progress in becoming the fund manager very quickly. Due to his superlative and consistent performance in contribution, he won several accolades and was appreciated on various platforms and nominated as a young leader 3 years in a row across an Aditya Birla Group. At the time of his departure from Aditya Birla, he was managing funds over $500 million. During his tenure, funds generated an average alpha of 280 bips over 5-year tenure with consistent outperformance versus the benchmark. He has also played a vital role in launching and scaling up Aditya Birla's fund during the time frame of 2016 to 20. So with no delay, let me give the podium to you. Over to you, sir.
Thank you, Akshara. Thank you for your kind words. But obviously, as they say, mostly in cricket and fund management, you're as good as your last innings. So, with that in context, I guess we will obviously come to the discussion of the day, spotting opportunities in current market. As you know, the market obviously is taken some volatile nature, particularly thanks to geopolitical risk rising. But the most important event that unfolded in September was a federal rate cut. After a series of round of rates and the long pause, which most people anticipated, US finally resorted to rate cut thanks to inflation taming. But more importantly, the quantum of the rate cut was surprising at 50 basis points versus a consensus 25 basis points. More importantly, going forward, we expect rate cut, to obviously cut by 100 basis points. Most of the central bankers are resorting to this particular tendency as we move to the next 6 months or so. Moving ahead, when we see what rate cuts obviously usually have for the markets. We have seen over the last many time frame. In fact, the rate cuts are typically taken constructively, and the data which has been analyzed over the last 2 decades, and multi-year time frame. Whenever the markets were at all-time highs and the rate cut happened, in 19 of those cases, it was great news for US markets, and 50 to 60% of time it was positive for the Indian markets as well. If you think from a larger perspective, 80% of time, markets obviously were positive to neutral in the domestic Nifty performance as well. So we think this time is no different, and in the initial phase, market tends to sort of rejoice such kind of rate cuts. Moving from rate cuts in the market anticipation to what is the implications that we read through. So if you look at the cost of equities, usually is inversely correlated to the interest rates. This is a very long, sort of tenure chart on the inverse correlation. You will see over a period of time as economy progresses, growth also moderates with the size of the economy growing disproportionately, and the reflection of real interest rates compared to the what multiples that you pay is absolute important element. So what we are trying to showcase here is it's 100 years in so many years, it's a 90-100 year chart with the progressive time frame and historical correlation. There's a 80% plus correlation of rate cuts and interest rates with multiples in the market usual, and there is absolutely no denial of the fact that this is prevalent across the world irrespective of what markets you look at. This is just a small example on how the interest rates usually impact a particular stock in terms of cost of equity. So by every 1 percentage points, this is obviously a very small example. We have assumed a 7% risk-free rate with the market beta of 1 and no debt in order to make it very simplistically. So when the interest rate goes up, the cost of equity also goes up dramatically, and that is where the impact on valuation comes on. So our belief is, and this is a fair value of the stock, assuming everything else constant. With every 1% change, you can see a significantly, between 12 to 15% jump in the cost of equity, and the fair value changes dramatically in proportion. So this is now at current juncture where we're standing at a nearly multi-year highs of the interest rate. Subsequently, 6 months means that for sure the cost of equities for global is going to see a southward journey. And to my mind, obviously rates are very, very prevalent. But what we should not completely forget is what are the drivers of the growth. To my mind, earnings are the very, very important drivers of growth. If you look at the Indian companies in back home, a 93% of the performance is led by profits, than only 7% is led by why multiple rated. In fact, if you just dissect the BSE 500 companies and you look at the last decade data, you will be surprised to learn that merely 22% of the companies delivered a greater than 20% profit CAGR. And importantly, when you look at the average for the index itself, it's only 12% CAGR over the last decade, which means that two-thirds of the businesses led to multiple, two-thirds of the businesses in terms of market cap led by earnings, and only one-third led by multiple expansion. So obviously, lower cost of equity is great for equities, but when you look at overall implications of what wealth creation happens, to my mind, earnings has been the core driver of those earnings, those of the portfolios. And that's exactly also what we think about long-term opportunity in the 10x fund and the 10x portfolio, where we emphasize on that particular, earnings as a core sort of attribute to of the portfolio construction. I think this earnings is a key demonstrator of growth and not multiples. We have also shared a few examples on the slide, right? And these are cross-sectoral. So it's not a B2C necessarily oriented businesses. It is a lending business, it's a consumer business, it's a discretionary business, and it's also an export business. So one thing that you see in common is the obviously the this is a 11-year journey of these businesses. The kind of wealth they have created is enormous. Between 10 to 20 to 30 to 40 times if you look at the journey of the businesses. More notably, the takeaway here is the majority of the growth in the market capitalization or the wealth creation journey is led by earnings, and multiples, as you can see, in most cases are very, very minuscule. In one of the examples that we have showcased is actually negative. In fact, multiple has derated. It's the great journey of earnings that create value. And more notably, all of these businesses, to my mind, has been a proven franchisee even 5, 7 years ago. Not that these businesses are newly undiscovered names, but importantly, these businesses have demonstrated disproportionate wealth creation proposition on core single hypothesis of strong execution led by very, very strong multiple growth. So that's in my mind is a very, very important element that people forget on, and we think this is a key differentiator of identifying good opportunities in the market, irrespective of what volatile markets that you sit in or what growth journey are you betting on. Moving ahead from what's the key sort of businesses that have demonstrated in the last few years, to my mind, and this has been proven track record, that the quality usually is a very, very sustained way to create wealth. In fact, if you look at if you refresh your memories, CY23 was a year where, and FY23 also, where disproportionately momentum did very, very well, where high beta did well, when also alpha did well. But if you fast forward to 24, particularly what happened by post the June election in the country, outcome of June election, and also subsequently with the better cost of capital after the Federal Reserve rates, you have seen not only the quality coming back, but also coming back very, very strongly. In fact, over a longer period of time, when you look at 10 years, 15 years, 20 years data, these businesses can So if you look at the last 10, 15, 20 years data, these companies have disproportionately created large sort of wealth for the investors, and these companies, and we have again classify companies basis on the growth profile, on the ROE profile, as well as their demonstrated execution profile. So the businesses in the Q1 and Q2 has far outperformed everybody else in the last many years, as you can see, and this is obviously clearly industry leading performance both in terms of earnings as well as bottom line. I would also like to just, sort of give another aspect to it, that once the quality, sort of starts performing, and with the lower interest rates, to my mind, the multiple that you end up paying for a good quality business, even goes up further, because eventually earnings yield is the reverse of P multiple, and we think that's going to see elevated growth as we speak forward, going in the next 2 3 years to come by. Uh, Moving on to what quality demonstrates to what our belief is, in going to be the next dark horse in this particular context, because we think spotting opportunity is very important to understand what the market is building in, and also what are the important sort of area indicators in each sector that one has to look on. So consumption is one of the sectors that we think can potentially stage a turnaround. Two three very important indicators that are showcasing this to happen. First one being rural market after a very subdued 2 3 years of time frame is will deliver upwards of high single digit growth in the subsequent 2 years to come by. Please bear in mind that rural market growth also was meaningfully impacted because of meaningful high inflation in the country in FY22 and FY23. In fact, as per the RBI data itself, the real wage inflation for the rural workers was negative in the full FY23 and in most part in FY24. So as we see, as we are sitting in current juncture with a very strong monsoon, with a very good distribution of monsoon across the country, and disposable income rising thanks to inflation contained in the country, we think this particular juggernaut of rural, which was not participating in the last 3 years, will see a certain strong comeback in the next couple of years to come by. Also, there is one more proxy that we look at which demonstrate that there is enough, and abundant alternative opportunities for the employment. So the Manrega scheme, which we obviously are very well aware, is a proxy to employ rural workers, has seen us consistently lower demand, which means there is enough and abundant opportunity in the market for these workers, and also thanks to a strong revival in the construction slash large absorber of the sectors of employment, which ensures the great sort of employment opportunity to come by. Moving to next, when you look at how has been the recent uptrend in the volume growth as well. If you look at the urban growth has obviously been the key driver for consumption, whereas rural growth in most of the in FY23 and 24 was actually negative. You will be surprised that not only the rural growth has come back, but obviously has started to deliver higher than urban growth in the last 2 quarters. And we think this particular trend will only accelerate going forward. In a consumption space, what is also equally important is because of, see, all these businesses in consumers and discretionary have undoubtedly very strong uh, business profile, extremely strong balance sheets, and demonstrated market share. But what was critical is the missing part was the earning growth. So if you look at the 21 to 24 companies, most of the consumer staples were delivering a very low is a single digit growth. In some cases, only exception were delivering a mid-teens growth. When you look at the outlook, most of the companies will obviously deliver 2x the growth of the last 3 years, and more importantly, eh, majority of them are trading it in line or marginal premium to their long-term averages, which means that any disproportionately earning growth surprises will be taken constructively from the market. In fact, in discretionary space, to our mind, the companies like Page, the companies like VMart, or even for that matter, Go Fashion will obviously showcase a reasonable strong growth as we proceed forward. And this is the consensus expectation that we are sharing. And we think that there is significant headroom for market to sort of get surprise on earning growth on these particular companies. So consumption is one of the sectors we think where spotting opportunities are clearly available. One needs to be very clear on what companies and categories one are looking at. But as we progressively move forward, we are seeing signs of improvement in this sector as we speak forward. Moving ahead from consumption to what other companies that we're liking. What we are picking up is in the software sector, IT companies. When you look at the growth numbers again, the last, and we have taken a 5-year number here in order to adjust the anomalies of COVID period. If you look at the 5-year CAGR, you will be seeing that majority of the large cap names and also some mid cap names were delivering between 8 to 12% earning growth. And notably, the total contract value or the total order book size of these companies in 4-year period or 5-year period have grown between 2.5 to 3x. So what we are trying to showcase here is the company has grown between 8 to 12%, and also during the same duration, the order book has swelled between 2.5 times, 3 times. Lately, in the last 2-3 quarters, we haven't seen disproportionate execution because of deferment of orders by the global vendors. Particularly, could be a function of uncertain economy, or could be a function of the impending election in the US. But one thing is very clear, that the order books at multi-year high, utilization levels is quite robust. So which also means they will have to hire new employees to contribute to the growth, and which is exactly why we think the earnings growth will stage a strong comeback in the next 2-3 years to come by. Moving ahead from what are the multiples of these companies, because that is also an equivalent important factor, because all the companies though are very strong, but also we have to understand what kind of multiples the market is paying for it. Majority of them are actually in line with the 5-year averages, barring 1 or 2 exceptions there, and particularly discretionary oriented businesses are trading at a significant premium. But if you look at the companies who are trading at a premium, are also the ones who will disproportionately grow in the next 2-3 years to come by. Our belief is this particular segment or the sector will obviously is sitting on a sweet spot where on one level we are seeing lower cost of equities by the rate cuts happening in the US, B sitting at a multi-year high order book, C utilization levels are at reasonably high levels, which means fresh hiring will happen. And also broadly the market believes that the dollar rate revenue growth rate will be between low single digit to high single digit. We think there is a reasonable amount of certainty that this particular number will be taken by surprise, and 26 and beyond will be the real game changer for the sector as a whole. And that's why this is the second important sort of dark horse, or let's say this opportunity that we think will align with the market. Moving to the next is another sector, I think so lot of questions or a lot of understanding is need to be developed. Chemicals is one sector that we think is again staging a comeback. So there are two very important elements that you can look at. One, how has the China share expanded in the last few quarters? And B, how has the additional capacity absorbed in the market? So, if you look at the number itself, see that the last 3 years, China expanded capacities in double-digit terms, and despite that expansion, market absorbed that expansion with not a significant dent on the pricing. The pricing index reflected on the screen is an average of several, chemicals and spreads in the last few years, and we think the index pricing is at almost a multi-year, or let's say a 15-year low, and there is in a lot of chemicals and spreads, if they fall even 10 percentage lower from current levels, they will actually make cash loss instead of making any operating profits. So we think with China reviving, as we know, taken by a few measures taken by the government, and also utilization levels getting absorbed despite the weak European demand, we think this particular sector is poised for a strong revival as we proceed into FY 26 and 27. Moving to next on what's the and this is a very important data point to understand. The gross block addition of the industry in a situation where the earnings were flat has been stupendous. In fact, the gross block addition has been 18% CAGR over the last 3 years, whereas the operating cash flow has been subdued. And the reason for lower operating cash flow was weak European demand as well as high capacity addition in the China. Now that we are sitting at a multi-year low inventory in the European markets and the China incremental capacity has already been utilized, we think the earnings growth of the industry is poised at 25% CAGR as we move forward, and multiples are in line with the medium term to long term averages for the sector as a whole. More importantly, and very sort of relevant data is the balance sheets of the sector of the companies, particularly good companies, are still not levered, and they are still generating a high teens to 20% ROC, which is again a very relevant factor to note. So these are the three sectors that I wanted to showcase, share. Chemicals, consumer, and software are the ideas or opportunities that we need to look on from the current market point of view. From this, we will obviously move ahead to what is the what are the 10x proposition or the opportunity from a 10-year point of view that we think on. So 10x is one of the portfolios that I manage, as Akshara also introduced. So 10x portfolio focuses on company who obviously thinks of investing from a multi-year point of view. To my mind, as I showcased in the previous slide, businesses that demonstrate long journey of growth are the one that creates maximum amount of alpha for the or wealth creation for an investor, are the ones one should be clearly focusing on. We think if a business have delivered has the potential to deliver in the next 10 years by around 10 to 12 times, those are the business one should be betting on, and that's the company focus that we are investing with. Importantly, these businesses has the opportunity, but what is the capital efficiency of the business? That is very critical, because you could have a great opportunity, but if you lose money, what's the point of having that opportunity? Because you don't make money for the investors. And more importantly, it's the real capital efficiency that plays out over a long period of time, rather than just trying to execute with losses that one brings on the table. Most of the combination of these two with exemplary leadership or strong leadership is the essence that we want to invest. Because to give an example, even the company like Nestle in the country was struggling prior to 2015, and after the takeover of Mr. Suresh Narayan as a new CEO after the Maggie crisis, we saw what happened, right? We saw how fantastic turnaround or stage comeback of Nestle has happened. So we think great business, good capital efficiency must also be backed by strong leadership. Otherwise, it becomes more of a sort of realized potential of a great business. And that's why when you have a portfolio or the companies which have these three tenants, are the ones who navigate cycles much better across time frame. Importantly, this is all cap portfolio that we sort of present to, and it also focuses on a blend of value and growth. And that is exactly the 10x that essence that we obviously offer. Moving on, and this is very, very critical perspective. When I say capital efficiency, when I say consistent delivery, when I say strong earning growth, when I say longevity, all that has to be backed with what intrinsic ROE, ROC, or cash the business generate. You could have all these four, attributes, but if you don't have reasonable, ROE, then there's no point of delivering that kind of business. So investing in such kind of businesses. In fact, we have backtested the data. Great firms deliver not only deliver consistently, but deliver significantly ahead of anybody else in the market from a long-term point of view. And two, three important questions that one must address while investing. A, is the business opportunity enough to reinvest for growth? B, is the incremental growth coming at a higher ROE and ROC compared to existing one? And C, whether the business will kick in operating leverage once the growth brings in. If all these three questions are yes, then absolutely certain that companies will fall into greatness category. In certain cases, the business may not have enough opportunity for growth rates, but what are they doing with the cash and the capital with them? Are they rewarding shareholders? Are they giving the money back to the players in terms of dividend or buybacks? That is another example of great businesses, but subdued growth. So to my mind, this is a very, very important element, and in some way, probably a more sustained way of wealth creation, and businesses who have demonstrated this particular attributes are the ones who have sustainably added to the wealth for the investors in the long run. Moving to the investment methodology that we use to look at these businesses. We obviously start the 500 companies that we obviously invest with. We apply a proprietary framework of a greatness that I just spoke about. Not only this enables us to look at the businesses from a number of companies to so as you're aware, majority of the companies are not able to deliver exceptional growth. The greatness framework eradicates subdued or subpar companies, and we focus on the balanced 50 of those, doing a complete bottom up research, very, very high growth oriented businesses, for doing a complete bottom up research of the companies through meeting the clients, through meeting the competitors, through meeting the distributors, and the whole ecosystem and supply chain, so that we can understand what is the real progress of the management conversation. Because what happens is, in most cases, management tend to overguide and have a very, very optimum view of the future, and that's by human design, right? So one needs to validate that thesis, and the only way to validate that thesis is what is the action that has been followed after the discussion then done by management. So we, in order to obviously validate the hypothesis, and B, see the on-ground execution process, we focus on the scuttlebutt approach. The portfolio management, again, hypothesis is to have a high growth oriented portfolio with less than 2 PEG, and divide the 20 stock into two different buckets of core and satellite. And that's how we intend to sort of manage this particular portfolio as well. In fact, we have also launched this for a global investors through GIFT City, and it will also be a dollar denominated fund as we'll progressively move forward to. So currently it's a portfolio offered for the domestic investors. As we move forward, this is going to be also offered to global investors in a dollar denominated fund. It's very well diversified. As you can see, it has an exposure across consumption, across IT, across chemicals, and also export-oriented beneficiaries like pharma, but also has a reasonable sort of presence in industrial, financials, and retail. Notably, not only this has a reasonably diversified allocation, but also a very, very strong earning growth profile with nearly 80%, sort of tilted towards mid and small caps. In this market where valuations are a little punchy, we think the portfolio ability to deliver a 23%, 24% earning CAGR with with a 1.3 time PEG ratio, because PEG ratio is something that's very, very critical to understand. And the 20% upwards of 20% of ROEs, this is poised to withstand any volatility if we view this in the next few sort of months to come by, and also come out with flying colors, because we think, and I said in the beginning, earning growth is the key determinant of the stock price and not the valuations itself. And good quality businesses not only sort of create growth but also sustain wealth creation. So, two, three important points I want to obviously summarize on. A, there are three some sectors that we are seeing opportunity in the country today as we speak now is software, consumer, and chemicals. B, earning growth is probably the most proven way to create wealth over the long period of time. And C, looking at businesses and identifying that can grow multifold, with has to be backed with strong capital allocation and leadership. So these three are the important summary point I want to share with before I ask Akshara to open up for Q&A. Thank you very much for your patient listening, guys.
Thank you, sir. Thank you for this very detailed PPT. I would say to start off with, you started off with macros of US economic slowdown, and then you went into the sectors part, and of course then about 10x. Now you also spoke about earnings. It was a very structured PPT. Thank you for that. And I would request the participants to if you have any questions, please put on this Q&A box, and not to ask any stock specific questions. So before that, I would request, to you to start off with, though you spoke about, macros and all, let us talk more on, investor sentiment now. When markets are at all-time high, and, investors, generally the feeling is that fear of missing out. And how do you think an investor can resist from the urge of investing without properly considering the fundamentals?
So thanks, Akshara, for asking this. And obviously, lately, as I also said, the market was also led by a lot of liquidity factors and fundamentals as well. I think the key differentiating factor an investor must look at is what is the core business fundamental that he is investing in. Because in times where the liquidity is a key driver of growth, usually fundamental takes a backseat, and people tend, most of the investors, including institutional, tend to play, or let's say participate in this rally in the near term. But however, what one differentiates is what is the growth of the earnings that business can potentially deliver. And as we proceed into FY25 in the second half, you see the inflation taming down to less than 4% at a much, much comfortable level for RBI. So with inflation absent, or let's say pricing power absent, earning growth, will all the more get difficult, because only businesses or companies who have pricing power, who can sustainably create execution, and who can sustainably gain market share, will be the differentiating factor in the current investment time. So I think as we proceed further, one needs to be very, very careful on what earning growth are they building in, what is the potential disappointments or the surprises they will get, and where are the real opportunities that they are seeing from a current juncture. Liquidity is something that will come and go, but that should obviously not be an epicenter to invest in any particular markets.
Got it. So when you talk about earnings, so we have got quarter one results, and next is expected of quarter two. So how do you see? What do you expect in quarter two?
Yeah.
Earnings.
So the Q1 obviously went a little soft thanks to the election in the country. Obviously, India was busy in election, so a lot of corporates, a lot of consumption got postponed, delayed, deferred. But as we proceed into Q2, a good monsoon, a reasonably, I would say, well spread out monsoon is obviously a great news for rural markets. But however, as we move and speak to a lot of corporates, we are sort of getting a similar sort of feedback of what we delivered in Q1. So we think maybe a high single digit growth in the Nifty earnings would be a reasonable expectations in Q2, and a low double digit growth for the mid and small cap index in the Q2 to come by. All eyes are pinned on the upcoming festive season, because we think this particular festive season, consumers also prepared to open their wallets thanks to a great FY 24 and 25, also sort of broader income levels, and also inflation tamed down versus expectations. We think strong H2 is a real focus point for the markets to year from here on.
Okay. Thank you. So let me take one question from the audience. Is that okay? From first question from Prithvi is that is it a good time to reduce equity exposure in the portfolio, considering that the Nifty valuations have given a rise of 23 to 24 times earnings, and the market cap to GDP ratio is at 150%. Should investor consider increasing their allocation to debt in anticipation of this upcoming rate cuts?
So yeah, a very interesting question. One has to also allocate capital basis on the horizon that one is to thinking on. So if somebody is thinking from a 3 year plus perspective, I seriously don't believe there is an alternative asset class which can deliver, in such kind of earning growth. So to my mind, any asset class who can deliver sustainably, let's say no low to mid-teens growth for a long period of time is the best asset class to invest with. There will always be bouts of volatility here and there. Plus, allocating more capital to fixed income or debt for the short period of time in anticipation of rate cuts, market tends to prices much ahead. When you look at the 10-year GSEC or the CPCD rates in the current juncture, you have already seen some signs of let's say softening in the yields in the last 45 days, which means market is ahead of time in pricing those rate cuts. So even if you go out and allocate more capital now, there is a remote possibility of you getting a most appropriate yield for your investments. I think again, going back to a 3+ year horizon or mindset, there is absolutely no doubt that equities will deliver disproportionate alpha compared to any other asset class, including maybe gold or even real estate for that matter.
Thank you, sir. That was an elaborate one. And moving on to the next question of the audience is that we'd like to hear a view on the impact of global geopolitical risk on Indian markets from 6 months ago to 2 to 3 year perspective from now. So he wants to the past and the future.
So, thankfully, the geopolitical implications so far for the market has not been very negative. In fact, on the contrary, with the falling crude oil prices, India being a net importer, if at all, India will be a net beneficiary, assuming this doesn't escalate to a World War 3.0 or 2.0, with multiple countries now getting into the geopolitical sort of disruption between Israel and Middle East and so on and so forth. We obviously would like to believe this could be, curtailed at a reasonable level, because beyond that, it's anybody's guess. However, I think given what happened, this particular geopolitical unrest began in 2022, if you go back to history, when the Russia-Ukraine war sort of began. And it's been 2.5 years, of this geopolitical uncertainty, whether it's sometimes Israel, sometimes Russia, sometimes some other country. Markets obviously have tend to move on these events, particularly led by strong fundamentals of the global economy. And I think the rationality will prevail in the future as well. If at all, if you think about OPEC as a large sort of supplier, their bargaining power getting weaker. India as a net importer of this crude oil commodity will be a big beneficiary in the next subsequent years to come by.
But talking about that, it is more like a follow-up question. The market depends upon the FII inflows, which
Yeah.
that generally shape up the market now. So with the US rate cut that happened, so what implications that you think the market would have?
In fact, very correct. I mean, to be honest, very apt question for the current juncture. If you go back to last several instances, the gap between India and the US is at multi-year low. The reason for FI, so think about being sitting in a US and investing in the global markets. For you to invest in any of the emerging markets, the hurdle rate went up very, very sharp because when you invest in US 10-year treasury, one was getting 5.5% 6% in dollar yield. Now with the falling interest rate curve from let's say 5% to 3 percentage points in a base case scenario, the net yield that you intend to maximize on your portfolio will move up. And that's why countries like India, maybe Indonesia, or even Taiwan would be a big beneficiaries. And to my mind, in the next 2 3 years to come by, India clearly stands out from a growth point of view. To give an example, in the last 5 instances where this situation has happened, where the interest rates came down by 100 to 200 basis points in the next 18 months time frame, all emerging markets, including India, got disproportionate FII flows in the next subsequent 18 months time frame. So I don't see anything will be different this time around. And FII tends to, and because of their yield optimization strategy and also lower yield at the current home market, they will tend to chase business countries or yields where they will get disproportionately higher returns on investments.
Okay, thank you, sir. So with that, let me take one question from the audience. From Amit Krishan's question is that can you highlight the reasons for private bank still not firing despite the great earning and asset quality? PSU banks also corrected significantly from last high. So adding on to it, generally in financials are mostly invested, is mostly invested sector by any PMS house generally. And
Yeah.
उसमें तो even PSU banks has been less considered by any PMS house. So
Correct.
along with this, please answer this question also, sir.
Yeah, so I think to be honest, there are if you look to financial, one of the best way to evaluate is what is the history for the sector as a whole. By design, in India, financials has a 1/3 plus of market cap or let's say profit pool in the country. But if you look at the volatility in the profit pool has been very, very high. Even if you take FY18 or FY14 or FY8 and so on and so forth, several phenomena. We started with FY24 at the multi-year high NIM, which is net interest margin. So we started this particular year where you're sitting at the best. It's a Goldilocks scenario where the asset quality was the lowest. I mean, I'm seeing the best asset quality in the last decade, the highest NIM net interest margin in the last 5 years, and probably the best ever credit growth in the last 5 years. So these three scenarios usually do not play out in tandem in the last 25 years in this country. Either of them have been either sort of subdued or one of those being exceptionally strong. So to my mind, fast forward to first half 25 or let's say FY25 end as well, financials will see some softening in the credit growth thanks to obviously what's happening in the economy as well. And also you cannot expect banks to make 5 percentage point net interest margin where the interest rate for the country is going from 9% to 6.5% in the last 2.5 3 years time frame. So what I'm trying to imply here is in the next 2 3 years time frame, earning growth will moderate. Also, thanks to lower credit growth as well as lower net interest margins. Which means again coming to PSU, the question that you ask is how PSU demonstrated market share gains in the last 24 months? The answer is not yet. Even in this duration, private banks have been a center stage in terms of market share as well as growth. Plus, also what has definitely happened is PSU revived from a very bad asset quality or reasonably good asset quality portfolio as I speak now. Moving ahead, it's the question of how much each of these banks will grow. And given the fact that private banks are available at reasonably lower valuation than their own past, there is that way a limited reason to still focus or exposure to PSU banks. So that's the broader reasons why financials will continue to, in my mind, not be a leader and B, why the we have a higher exposure to private banks as a broader industry or other as a broader institutional investments.
Yeah, it's so again a follow-up question. Apart from financials, there are other sectors like capital goods, healthcare, where more PMS are also interested in and they they invest more. So don't you feel there's a herd behavior in these sectors? And in these sectors, you have a very less exposure to. So is there anything that you want to answer on this, sir?
So, yeah, Akshara, so capital goods, to be honest, I'm not very certain about a lot of other, sort of players, but we have by design not very heavily exposed because we have obviously thinking about capital good or capex proxies than in the real capex growth stories in the country. Because to think beyond 3 years in capital goods is a more of a shooting in the dark, sort of exercise that one needs to do. Although the opportunity in a lot of these names are very, very high, but as you're aware, and we've seen in several years, these go through a shallow cycle to deep cycle depending on what segment you look at. So healthcare again, barring a few hospital names that we think of, and the pharma companies, particularly domestic oriented companies, have only showcased the sustained earning growth. Most other obviously have been unfortunately vulnerable to what happened in the US markets, particularly the US regulator. To my mind, select healthcare opportunities is still very attractive as the growth remains very, very strong in the next 2, 3 years to come by. Unfortunately, the multiples in the cap goods are not giving that comfort to sort of sustain that kind of premium that they're quoting at compared to last 5 years. So either the growth has to accelerate for somebody to allocate more capital to it, or you will start seeing some time correction that will lead to reasonable expectations from P multiples. So I think between the two, I would pen my bets more on healthcare because domestic businesses are coming with a lot of innovation and have acceleration to growth because of the introduction of businesses.
Oh, thank you, sir. Thank you for that. And we have one more. There are a lot of questions following on to him saying, talking more on the sectors.
Yeah.
And so let me take the last question first. So the mid caps have seen amazing price appreciation over the past 3 years. For someone entering the market now with a long horizon, how do you suggest allocating between large, mid, and small cap?
So, the question is very relevant at the current juncture. If somebody has a, around 6 to 12 months of perspective, I think so, having a tilt towards largish mid cap and large cap is a good strategy to have. But I again go back to the question of, whether you want to think from a 3 year point of view or 3 quarters point of view. If one has to think through a 3 years view, the earning growth profile of a large cap will still be in the low teens at best, whereas the mid and small cap would be able to deliver very, very strong growth because of execution, because of better management, or because in cases of wide spaces which large cap doesn't want to address to. And 6 months, maybe 9 months, one could think of large cap and largest mid cap just to overcome the volatility if that hits us. But 3 years, absolutely no doubt, the mid and small cap will be the clear winners, both in terms of earning growth as well as potential performance for the investors.
But sir, when you say about earnings of small and mid cap, don't you feel the space is being overvalued or the field feels exhausted of that market cap especially?
So, Akshara, the way to think is when you look at valuations, one should also look at how is the uh, balance sheet of the business looking forward. To give you an example, you go back to FY18 when the multiples of the mid and small cap were at similar juncture. The leverage of the mid and small cap was far, far higher. The ROEs were far lower, and also the quality of the earnings was far inferior. At current juncture, we are sitting at 15-year low leverage. We are sitting at a maybe 7-year high, ROE. And more importantly, the quality of the earnings is far superior. It's not, isolated or coming from 3, 4 sectors. It's more broad based. Also, what is also very, very important is lot of these structural changes or reforms like GST, like ARERA, like digitalization that the India is going through. lot of small SME, small cap, small and medium enterprises, not necessarily the stocks, I'm talking the companies in the economy are, becoming stronger and stronger to deliver sustained growth, which is a great news for the economy as a growth itself. So, you're right, multiples are high, but also the, multiples in conjuncture to what kind of balance sheet and the profitable growth that they are delivering is a very, very important element. One must not miss that.
Got it, sir. Thank you. Let us focus on this 10x portfolio now. While talking about it, 10x means like, which bets on India's next 10 year, the golden decade of India. So what are the sectoral bets that you have? Or multi-year for the multi-year growth. Of course, you took name about software, which ITs. I was surprised when you took ITs because generally when US slowdown happens, generally
Yeah,
people come out of ITs. When you said ITs, I was quite surprised. And of course,
yeah.
consumer chemicals. These were the sectors that you took. Apart from these, is there any other sectors that's going to have a multi-year growth?
Yeah, I think so. Financials obviously is one of the sector that we cannot obviously ignore because of the size of the market. But also, one needs to be very clear on whether we're talking about lenders or non-lenders, because we think non-lenders is also progressively taking a very large center stage in the next 5 years to come by. So if you think about, for in our mind, there are three, four multi-year opportunities. A, consumer and discretionary, one big baskets that is going to, play a multi-year growth story. B, manufacturing and export driven businesses, whether it's import substitution opportunities like in chemicals, or export oriented businesses like software, or even for that matter, in some cases pharma companies who will become a big beneficiary of manufacturing, because not necessarily one has to be manufacturing a particular product. It could also be a company who can serving the world from our country. So that is obviously an important element that we are betting on. And third, financialization and credit, obviously, growth of the country is another multi-year opportunity that we are thinking. And within the financialization, one is lender portfolio, which is bank and financials and NBFCs, and the second is the other proxies which are beneficiaries of wealth creators. For example, the wealth related management businesses, for example, capital market proxies, and so on and so forth. So these three are the mega themes in my mind will continue to demonstrate outsized, sort of earning growth in the next few years to come by.
Thank you, sir. Thank you for that. Let me take one question from Pawan. Is that food delivery business space is saturated, or still some space is there for new companies to enter? So, adding the one more question to us is about the new age business. How
Yeah.
do you evaluate it? And when it comes to new age business evaluation, there's always a consideration having an unconventional model with long time profitability. So,
Yeah.
how do you see this?
No, fair point. So, there are, first of all, to answer that question of food delivery, to my mind, whether new participants come into that particular segment, it's a function of how aggressive that participant or the competitor is, and b, what is the response of the existing competitors for that, because eventually it's a function of what is the customer acquisition that you do and at what cost that the customer comes onto your platform or your business. If somebody is ready to spend $1 to get a customer who will eventually deliver, give them a 50 cents or 60 cents, then it's a model that they are choosing to throw money at the current juncture and maybe wait for the future to whenever they can turn profitable. So to my mind, food delivery is hyper competitive. A new player coming exactly today will take 3 years to build its mode, and not necessarily will be a great sort of sign for the industry as a whole. To come into the question of how do we evaluate new age businesses, the focus for us is not profit only. The focus is on the unit economics. If the unit incremental growth of unit economics is actually coming at a cost lower than the preceding 2, 3, 5 years time frame, or in certain example 2, 3, 5 quarters time frame, we will be happy to look at those businesses very seriously, because a customer acquisition cost could come lower at at every by every passing year, and b, operating leverage should kick in the business even if it's their losses, but the incremental capital employed should deliver far superior ROEs, incremental. That's the two important metrics, apart from large opportunity and the better execution capability that the management brings on board.
Okay, thank you, sir. With benefit of time, let me take these last two questions.
Yeah.
To talk more about your 10x portfolio, it's a concentrated portfolio with 15 to 20 stocks.
Yeah.
When it is a concentrated portfolio, entry and exit is very crucial. So, can you just take names of any of your recent exits that you had or the entry that you had? Of course, no stock. This is not a stock recommendation, but
Yeah, yeah, sure.
know
Fair
about
point.
your portfolio.
So I'll tell you, a couple of examples. So as you in constant portfolio, what matters is, to my mind, what is the hypothesis that you invest with, because at times entry and exit could be very uh, maybe inappropriate in some cases. To give an example, we moved out of Laurus Laboratories in one of our portfolios because we thought, the company should be a big beneficiary of CDMO opportunity. Although they built a lot of businesses in terms of gross block addition, client concentration, and so on and so forth, but none of them realized into the earnings growth that we were expecting out of it. So, our hypothesis, to my mind, obviously, is this business will have to go super aggressive to gain market share or to gain customers, which is again be detrimental for the incremental capital efficiency. So that's where we obviously moved out of that name, and we got into a consumer oriented business called Vector Foods. The idea of that, and this was again 7 to 8 months ago, not now. The idea was again to think about incremental growth could be better than what it was in the last 2 3 years, and consumer rural and semi-urban picking up was another sort of mindset that we had. Depend apart from the fantastic product profile that they have, good management and leadership, and also they are the only potential pan-India company that can actually compete in a smaller company with Britannia, apart from Parley, obviously, and Sunfeast doing what they're doing at all. So, again, thanks to the growth and the revival of the businesses, the earnings and the stock price has delivered. But the idea is to think from a 3 year point of view, whether that company can deliver exponential growth in the earnings in the sector itself, and whether the company in exits will be failure in terms of earning growth. And that's the core epicenter of our thought process when we invest or exit in a particular portfolio.
Okay. It is out of curiosity. Is there any stock that you existed early, but that after that it rallied much higher? Do you have
Yeah,
any
so
details
honestly,
on that?
yeah, so in one example, we moved out of Aavas Financials after the promoter moved out from. I mean, promoter was obviously asked by the investors to move out, and post our exit, the stock went up by 20% in a matter of 2 months, 3 months time frame. But thanks to our hypothesis that if the person who has founded the business with the core culture is not running the business anymore, uh, the professional team that going to change overnight will not be able to demonstrate execution. And after we did into subsequently 3 4 quarters, the performance was so poor that it actually went back to the price that we sold out. So there are some examples where it moved up in a short period of time, but again back to fundamentals, people will sort of appreciate or sort of penalize the company based on the performance on the midterm.
Okay, so there's no regret on that part actually. So last
Yeah.
question for this day is that when at current markets at all-time high now, and what are the factors should an investor should be mindful of before investing? You can name any three.
Yeah, yeah. So basically, I'll pick up the first one that you highlighted the question with. One, the general geopolitical issues that we are seeing globally. We just hope the geopolitical issue does not corroborate meaningfully. That's a big question that one has to keep in mind. Second one, being the what's the recession being set up in the U.S. economy, because that's a factor one clearly needs to keep an eye on. So a few indicators are indicating softening of the demand and the economy, but we don't know when it turns to real recession, and that's the one factor one should look at. And probably third should be domestic earning growth, because eventually that's where we are paying a premium for, and that's where the sustainable of growth is one betting on the next few quarters and years to come.
Okay, thank you, sir. So that was it. That is done the webinar. And of course, we have there are a lot of questions which still remain unanswered. So I would request each of the participants to, if your questions are not answered, please mail it to events@PMS Bazaar. So I will mail it to you, sir. I would request you to take some time to get them answered. Yeah.
Sure, ma'am.
Yeah. So thank you sir, for your time, and also it was very elaborate PPT. We could know more about 10x as well as the markets.
Yeah, really appreciate. Thanks for the opportunity. Thank you very much.
Thank you, participants, for your patience.